Hey guys, in this video, we're going to break down a full rules-based day trading strategy that works well in the Forex, crypto, and stock markets. The strategy we will share today is what I would start with if I were a beginner or a struggling trader seeking an edge over the market and making a consistent income. This price action trading strategy combines concepts of market structure, pullbacks, and advanced candlestick entry setups. So if that sounds good, as always, make sure to hit the like button to show your support and subscribe to our channel if you're new, since we publish many advanced trading knowledge. As I mentioned earlier, this price action trading plan is a pullback trading strategy, combining multiple market structure factors with an advanced candlestick pattern as our entry reason. This trading setup is not limited to any time frame, but our preferred time frame to use this is 1 hour. It works on any market, so you can use it when trading stocks, crypto, or currency pairs. The pullback trading strategy is a trend continuation setup that consists of 2 trading models. Also, we use 2 advanced candlestick patterns as our entry, which are highly similar. However, the psychology behind them is slightly different. Generally, this trading strategy is designed to capture impulsive moves during a highly volatile trending market. So without further ado, let's jump into the steps and rules. This strategy consists of 3 major steps in both trading models: identifying the market direction, waiting for a pullback, and entry reason. So let's start with the first step, identifying market direction. In this step, we apply a simple concept to identify the market direction, because we want to trade with the controlling side of the market. We do this with the aid of the exponential moving average. So we apply the 50 EMA on the chart, and simply wait for the price to break it to one side and create a new high or low. Then, we can identify whether we're witnessing a bullish or bearish market. For example here, the price has broken the 50 EMA, and also the previous market structure to the upside, and created a new high. So, we have a bullish market, and now that we have identified the direction, we can continue with the following steps and look for long opportunities. Same thing for the bearish scenario. Here, the price has broken below the 50 EMA and the previous market structure, creating a new one. So, our direction is bearish, and we can look for short opportunities. Trading with the dominant trend will instantly improve your win rate and risk-to-reward ratio. Now that we know how to identify the market direction, let's continue with the second step, waiting for a pullback. Now, there are many ways that traders identify a valid pullback, but the rules we use for this particular trading setup are very simple. We wait for the price to print at least 2 opposite-colored candles after an impulse, which shows a sign of a temporary correction phase. The same concept is applied to the bearish scenario. We need to have at least 2 green candles to confirm the pullback. Waiting for a pullback will optimize our entry, allowing us to enter at a better price and catch maximum profits. The third step is making the entry. Now, what we've discussed so far in this video is market conditions, right? We looked at the market trend to align with the controlling side, pullbacks to enter at a better price, and market structure to confirm our analysis. Now, what we need to create an actual strategy besides these conditions is entry reasons. When exactly enter the trade and exit if we were right or wrong. Now we use 2 candlestick patterns as our entry to predict the end of the pullback and the start of an impulsive move. These reversal candlestick formations are, in fact, advanced engulfing candlestick patterns. Engulfing candlestick formation is one of the most powerful price action reversal patterns, which I'm sure you have all heard of. This pattern consists of 2 candlesticks in which the body of the second one has an opposite color and engulfs the body of the first one. However, to use the engulfing candle as our entry reason for the pullback strategy, it must meet some of our rules. In pattern number 1, the green candle's body must be bigger than the red candle. We need to have the color change, and the green candle has a lower low than the previous candle, meaning the green candle is also a swing low. When that's the case, that is our actual entry for the pullback trading strategy. We will open the trade at the close of the green candle and place our stop loss below it, which is our latest swing low. This was entry number 1. Now let's take a look at entry number 2. The second engulfing pattern is highly similar to the first one. We have the body with the opposite color closing above the first one, but the green candle is not our swing low. However, we can also use this as our entry reason only if the red candle has created a lower low than the previous candle. What this means is that, basically, the second engulfing entry pattern also creates a swing low. The same concepts apply to the bearish scenario. So, let's take a look. In the entry number 1, we have a bearish market. We have this impulsive move followed by a pullback. So, in this setup, we want to see an engulfing candle with a color change and a bigger body that creates our swing low. Then, we can place our entry at the close of this candle and set our stop below the swing low. Similarly, we have the same impulse and correction in the second pattern. The market has printed a red engulfing candle, and the green candle has created a new lower low, making us a fractal move. So these are the only 2 entry reasons we will be using. Anything other than that is not a valid entry. Now, let's put things together and have some real chart examples. We have a bullish market on the pound-yen 1 hour's chart. Price is trading above the 50 EMA, and we have the 2 candlestick pullback. So all we have to do is wait for the market to print our candlestick entry patterns to enter a long position. Here, we have a valid entry reason. So we will open a buy position, set our stop below the engulfing pattern, and target 2 times what we have risked. The bullish engulfing candle signals a bullish reversal. It indicates a rise in buying pressure when it appears at the bottom of a pullback. So this is a highly accurate way to enter the market when you combine it with the right market conditions. Same thing for the bearish scenario. We want to see the price trading below the 50 EMA. Then we wait for the price to print 2 bearish candles and take it as our pullback movement. Finally, we wait for the price to print one of our advanced engulfing candlestick patterns to enter a short position. Our stop will be below the swing high, and we will target 2 times our risk. Now this was the first trading model. Let's continue with the second one. But before we continue, as always, please hit the like button to help our team in creating new videos. Also, comment below and tell us if you would like to have more price action videos or smart money concepts. This trading setup is identical to the first one, with 2 major qualifications. As before, in the first step, we want to see the market trading above the 50 EMA and create a new high in the bullish scenario. Then we wait for a 2 candlestick pullback, but the difference here is that the pullback must touch the 50 EMA, so that's one change in the rules. We need this pullback to retrace all the way down to the 50 EMA and be at least 2 candles. Now here is another extra rule. Once we get here, we want to see the price gets rejected from the EMA. This rejection can be by wicks, or we can only see 1 candle that closes below the 50 EMA. The price must immediately get inside the range. If that does not happen, then it will be an invalid trade. After getting this kind of pullback, we can place the trade based on the engulfing candlestick pattern we previously discussed. So, as you can see, guys, creating these specific rules for how we enter the market based on conditions and entry reasons that I just showed you make your trading very rules-based and non-subjective. Writing down all of the rules and following your trading plan will help you know exactly how you place the trade when the opportunities arise. It makes your trading very simple, and simplicity is the key to profitability. Now, there is only one important concept left before placing a trade based on this strategy: analyzing the market structure. This trading strategy is a trend continuation setup, so we must be aware of reversal signals that the market provides. There are 2 types of market factors that we have to keep in mind: higher time frame key levels and reversal chart patterns. Before placing any trade, we should check how much room we have before reaching the higher time frame key level, because a small reaction to these levels can be a major trend change in the lower time frames. So we only enter the market if we have enough space before reaching the next level in front of the price. This concept will help us avoid losing trades and catch great risk-to-reward ratios. So basically, combining the multiple time frames will help you get a clear and well-informed chart analysis. The second market factor is reversal patterns. Reversal patterns are chart formations signaling that the ongoing trend is about to change course. If a reversal pattern forms during an uptrend, it shows that the buyers are losing momentum and the sellers are taking control, and vice versa. The most popular reversal patterns we pay attention to on the charts are double top, double bottom, and fakeouts. When these patterns form on the chart, we take continuation setups more cautiously. So, guys, at this point, you have everything you need to begin backtesting the pullback strategy we talked about. Backtesting is really important, and you should take it very seriously, and the reason is backtesting is the foundation of your trading strategy. It will help you to obtain the performance of your trading setup and the confidence needed when trading opportunities arise. Now, here are some of the important points when it comes to backtesting your trading setup. 1. Do backtesting from left to right by going forward candle by candle. 2. Take the trades as you would when you are trading with your real money. 3. Stick to all of your rules and don't change anything. 4. Test it with the market reply if available so you are completely unaware of the next market movements. 5. Obtain the results of your trading plan as if you are looking for a long-term consistent income. 6. Stick to your risk management plan in your backtesting to gain a realistic result. Step. We use the TraderEdge platform for backtesting our exclusive trading strategies. If you're interested in using TraderEdge as your backtesting tool, be sure to check out the link in the description below. Now, as usual, let's open the trading view chart to show you step by step what is going through our minds when trading opportunities arise. Here, we have the US 30 in the 1 hour's time frame. The price has recently broken below the 50 EMA, creating a new low. So, we have a bearish bias. Now, before we start the chart replay and look for short opportunities, let's check the higher time frame to see the bigger picture. Here on the 4 hours chart, we can see that we have hit this key level, which could be a turning point for the price. The market has strongly rejected this area multiple times in the past and made a double top pattern, which is another reversal signal. So once again, we also have a bearish bias on the 4 hours chart. Now, we can catch short opportunities on the 1 hours chart, and our target would be this key level of market structure that strongly rejected price multiple times. So, let's return to 1 hour's chart to continue our analysis. Step number 1. The direction is bearish. So, let's go forward and wait for a pullback formation. Here we have 2 bullish candlesticks. So, the pullback is confirmed. Now, what we want to see here is that we want the price to continue trading below the 50 EMA and make an engulfing candlestick pattern to execute the trade. So here the market has printed our number 1 engulfing candlestick pattern. So this is our entry reason to go short. Let's open a short position, put our stop above the swing high, and target 2 times our risk. Here, we have another valid engulfing pattern, so let's open another position. Here we have another setup. Here, the market has made a deep retracement and rejected the 50 EMA, our second trading model. But unfortunately, since we did not have our engulfing candlestick entry reason, we missed this trade. Here, we have another entry setup, but the problem is that we have reached our higher time frame key level. Now, we must wait and see what the market will do next. So let's check the 4 hours chart one more time. Now, here we can see that the price is in this strong demand area. So here are the high probability scenarios. If the price manages to break this level to the downside, we can expect the price to fall to the next support area here. But if the price gets back within the range, we can expect the price to rise and our long-term target will be this key area. Now, let's zoom into the 1 hours chart. Now the market has reversed and broken above the 50 EMA. So let's wait for the price to confirm the bullish direction by making a new high and looking for a pullback. Here, we have a valid pullback, our number 1 engulfing entry pattern. So once again, let's open a long position. This is the proper way of backtesting your trading setup. This was just an example. No trading strategy always works well. In your backtesting, you're going to witness many losing trades. So always remember to have a proper risk management plan to stay in the game. So guys, that's it for this video. I hope this video provided value to you. If it did, please go ahead and smash the like button to show your support. And if you're new here, consider subscribing to our channel. See you in the next episode.